Let us look at some of the amendments which have been made in respect of taxation of non-residents. The first one is in relation to storage and sale of crude oil by foreign companies. Now in this case, what can happen is that if there is a foreign company which wanted to sell crude oils to the Indian company, it could have sold it directly, right? But in order to incentivize these companies, they have been given an option where they can store the oil in an Indian facility and thereafter transfer it to the Indian company. In such a case, if the foreign national oil company and multinational company who was storing crude oil in a storage facility in India, and they also sell crude oil to a person resident in India, the income from such an activity will be exempt, provided the storage and the sale is in pursuance to an agreement with the central government, or such an agreement is approved by the central government, or having regard to the national interest, the foreign company and the agreement or the arrangement are also notified by the central government in this behalf. The second is in the context of foreign mining companies in respect of display of uncut diamond. In such a case, it has been provided that if there is a foreign company which displays an uncut diamond in India, who is engaged in the mining of diamond, no income shall be deemed to accrue or arise in India if it is only displaying uncut and unassorted diamond without any sorting or sale, and such a display is done within a special zone notified by the central government in this behalf. There is a preferential patent regime which has been introduced in India. In this case, what happens is that until now, the foreign companies were outsourcing R&D to India. The Indian company used to develop patent, but these patents were registered overseas, right? They may not necessarily be always registered there, but chances were that the patents were registered overseas because the tax regime in India wasn't very conducive. In order to provide an incentive to the foreign company to have the patents registered in India with the Indian company, it is provided that if there is a person resident in India, which is the ICO in our case, who is a patentee and is eligible for this tax treatment. So if the patent is registered in the name of the Indian company, then a tax benefit could be available. And what is the tax benefit? The royalty income in respect of the patent developed and registered in India, along with the services in connection therewith, shall be taxable at 10%. Transaction of sale and transfer are not covered in this particular section, and there is no expenditure which will be allowed in respect of such royalty income. The term royalty, developed, patent, patentee, patented article, and first inventor have been discussed in this, right? And it has been defined that the royalty includes not only transfer of rights, it also includes imparting information and use of patents. Then there are certain changes relating to the place of effective management or POEM, which is there. The application has been deferred by 1 year. The central government is going to specify that in case of a company which has POEM for the first time in India, how shall the provision of IT Act apply, right? More particularly, in case a company is treated as having a place of effective management, till the time the assessment is completed for the first year, when it is treated as having a POEM, how shall the compliance be done, right? It has been provided that the notification relating to POEM shall be laid before both the Houses of Parliament, and it is going to apply from assessment year 17-18. Another cumbersome requirement which was there for the foreign company was to obtain a PAN number in India, particularly in cases where the payment which were being made to them were made after deduction of taxes as per the treaty or as per the act. In order to provide relief to these foreign companies, it has now been provided that if there is a non-resident who gets some payment from a resident in India, okay, and the taxes thereon have been withheld as per Chapter 17B, right? In these cases, they will not be required to apply for a PAN number in respect of 1. The interest on long-term bonds referred to in section 194 LC, and any other payment which is subject to such conditions as may be prescribed. They may be required to give certain documents, etc., but they will not be required to obtain a PAN number. The question of applicability of MAT on FIIs and FPIs has been a question of very much debate. Effective from 1/4/2001, the rules are proposed to be changed. So it's a retrospective amendment, but definitely for the betterment. So in such a case, if there is an FII or an FPI who does not have a PE in India, right, in case they are selling investments or sale of shares, no MAT is going to apply to them if you are coming from a treaty country. Then if you do not have a PE, which means if you have a PE, this question or this applicability may not be there. In case you were coming from a non-treaty country, if the FII or FPI were not required to seek registration under any law for the time being in force relating to companies in India, then MAT is not going to apply to them, and this is effective 1/4/2001. Again, there are a lot of speculation which was going around in terms of whether India is going to impose country by country reporting and master file requirement for transfer pricing purposes. In line with the BEPS requirement and regulation, India has introduced the CBC reporting and the master file reporting. What has been provided is that the CBC reporting is going to apply to international group whose consolidated revenue is above 750 million euros. Second, in case there's an Indian parent company which is above this threshold, then they are also required to file report to the prescribed authority on or before the due date of furnishing of return of income. So let's say in case you are an Indian company who has this turnover, right, or the revenue, then you have to file the CBC report with the prescribed authority in India on or before the due date of furnishing of return of income for the relevant year. But in case of Indian constituted on foreign group, right, so if you are a subsidiary of a foreign group who is covered here, they have to provide the details of the parent company on or before the prescribed date. If there are more than one foreign company in India or the foreign subsidiary in India, then you can nominate one of the entity to submit the details. Again, if the parent is from a country where India does not have a CBC exchange agreement or the country is not sharing information, the Indian entity has to file the CBC report to the prescribed authority on notification. The authority can call for and request certain information as desired. If you do not furnish it, there will be penalties. Now, this was all for the CBC reporting. In respect of master file, the information required shall be provided as per the rules which will be prescribed in line with BEPS AP 13 rules. The non-furnishing of information in respect of master file can result in a penalty of rupees 5 lakh. Again, this is something which is very important. So there's an equalization levy which is proposed to be introduced under Chapter 8, whereby in case there's a non-resident who does a digital supply of goods and services to an Indian business, then they shall be liable to pay an equalization levy which shall be 6% of the consideration for specified services. Okay, these are meant to address the challenges in terms of digital economy transactions where the Indian government was not able to collect appropriate taxes. The good news is that it is applicable only when the non-resident is dealing with a person who's resident in India who carries out business or profession, right? Or there's a person who's a non-resident who has a PE in India. So either an Indian business or a PE of non-resident in India, if they are making payment to the non-resident for covered services, then 6% of the consideration shall be chargeable as equalization levy. Right? It's not applicable if the aggregate consideration does not exceed 1 lakh. Once this equalization levy is applicable, the non-resident is exempt from tax on the income arising from such services. The central government is expected to make rules to notify the application of equalization levy.